Hello and welcome to another exciting edition of Accounting 210. Today's episode is about Chapter 7, which is about liabilities, about when companies borrow money. Even if you have made the decision not to borrow any money, you can't help but have certain types of liabilities that just pop up in the day-to-day operations of your business. And we're going to talk about two of those today: sales taxes and payroll taxes. So let me get me out of the way. And first of all, let's talk about payroll taxes. Suppose Baker Corporation had total sales in the month of March of $50,000, and 20% of those were in cash and the rest on account. And the sales tax rate is 8.25%. So I chose that rate because that's what the rate is here in Abilene, Texas. 6.25 is the state, and the other 2% is local. So the way this happens, when you go into business and you're selling a product that is subject to sales taxes, you have to register with the state. Sales tax is a state tax. We don't have a national sales tax. Some countries do, but we don't in America. So you would register with the state that you're operating in, and they would give you the forms and all of the information that you need. And typically, the sales taxes that you collect in one month, you're going to have to pay sometime in the next month. So let's say that the taxes that we collect in the month of March, we have to pay by April the 20th in order to be on time. Anytime it comes to taxes, since you're dealing with the government, you want to pay on time. If you don't pay on time, then they will impose penalties and a lot of times interest on the amount that's overdue as well. That can add up to be a pretty hefty amount. And if you are real lax in paying your taxes, a lot of times they'll just shut you down. So sometimes if you see a company, maybe even a new business that just kind of seems to shut down overnight, very likely they were behind in their taxes and the government did that. So you want to pay your taxes and you want to collect the taxes, sales taxes from the customer, and then it's your obligation to pass that on to the state. Then the state will take care of getting it to any local governments involved. So if we had $50,000 in sales and the tax rate was 8.25%, the total taxes would be $4,125. So here's the journal entry for that. The total amount, including taxes, was $54,125. 20% of that was collected in cash. So we would debit cash for the $10,825. The rest of it would go to accounts receivable, and the credits would go $50,000 to the sales revenue, $4,125 to sales taxes payable, a liability account. This is what we owe to the government. Now, notice there is not a sales tax expense account. This is not our expense. This is paid by the customer. We just have the responsibility of collecting it and then passing it on to the state. So we established a liability here, sales tax payable. Of course, it's in the liability section of the balance sheet. If we pay by the due date, some states, not every state, but some states will give you a little bit of a discount to compensate you for your time and trouble of collecting the taxes for the benefit of the state. So let's say that we're in a state that gives us a 1% discount. So 1% would be $41.25. So we're going to write a check to the government for the rest of it, $4,083.75. And that discounted payment will take care of the entire liability. So to put this into practice a little bit, if you look at the bottom part of the screen, now before you look at the answers, read this problem, and you may want to pause the video for a second and see if you can work this problem. It combines your understanding of sales taxes with credit cards like we talked about in Chapter 5. So pretend I went to Walmart and got a flat screen TV for $650, and let's say it was a 7% sales taxes. And I pay with my MasterCard. And according to the agreement between Walmart and MasterCard, there's a 2% transaction fee. Now remember, that transaction fee is not what I'm going to pay. That's how much Walmart is going to pay essentially to MasterCard because they're using their credit card. So, question A, how much am I going to send to MasterCard? How much is MasterCard going to send to Walmart? And then how will Walmart record this transaction? So again, you may want to stop the video and work that. Now let me go through the answer. The amount I'm going to pay to Walmart would be the $650 plus the 7% tax. So $695.50 would be the total that I would pay to MasterCard when they send me a bill. I'm not going to pay any interest on it because I pay my credit card balance off every month. MasterCard is going to keep I think we said a 2% fee, keep a 2% fee. They'll keep 2% of that total and send the rest of it to Walmart, which is $681.59. So the way Walmart will record this is they would have a receivable from MasterCard for the $681.59. That's a very quick receivable. It would be collected in 2 or 3 days, so it's almost cash. And then the $13.91, that would be Walmart's expense. They're not going to get that amount of the money because they're using credit cards, accepting credit cards. And then the credit would be to sales and to the sales tax payable. So that completes the discussion of sales taxes, and now I want to move to a discussion of payroll taxes. So on the next, let's assume that you graduate and you're making $36,000 a year. That would be $3,000 a month. So in the past, we have simply debited wages expense for $3,000 and credited cash, but you know that you're not going to get that entire $3,000 in a check because the company, your employer, is going to withhold certain amounts from you. So in this first box, I'm going to summarize some of the withholdings, and then we will record it in a journal entry. The very first thing that's withheld, comes right off the top, is 7.65% for what's called FICA taxes. That stands for Federal Insurance Contributions Act, and you know it as Social Security and Medicare. So I have the percentages here broken down between the two. It's a total of 7.65%, which comes to $229.50 when you take that percent of 3,000. For exam purposes, you do not need to know any of the percentages that I'm talking about. I do want you to know what types of taxes have to be paid and also who has to pay them. On the FICA taxes, half of it is withheld from the employee and the other half is paid by the employer. In other words, the total FICA tax is actually 15.3% of the payroll. But half of it, 7.65%, is withheld from the employee. And then in a minute, we're going to match it with the employer. Let's assume that the income tax being withheld was $200. And again, the income tax withheld would depend on how much the employee makes and how many exemptions they claim on their W-4. Um, Everybody has one exemption for themselves. You may get another one for your spouse, and then have one for each of your kids. So somebody with 4 kids would have less withheld than somebody that doesn't have any kids. Well, let's just say $200 here, just to put a number out there. Um, if you are part of a health insurance plan, then that amount would be withheld. And these days, that's certainly a good thing to do, and it would depend. The amount withheld depends um, on 2 things. How much is the insurance company charging for your monthly premium? And secondly, how much of that does your employer pay? You may luck out where your employer pays almost the whole thing. But let's say that you're paying for $200 of that premium. Then we come down to what's called the 401k contribution. This would be your retirement plan. Let me just say a word about that. In the old days, when somebody went to work with a company, a lot of times they would stay with that company for their entire career. And then when they retired, that company would continue to pay them a pension during retirement. And that pension would be based on how long they had worked with that company. Well, these days, it doesn't work that way. Companies figured out that those pensions cost a whole lot of money. And so they did away with that. And instead, we have what's called a 401k contribution. The way that works is you, the employee, you contribute to that. And then when you retire, 40 years down the road, whatever you have saved in that, that's what you get for retirement. So if you haven't put anything into it, there's not going to be anything there for you to retire. The nice thing is that a lot of employers, if you put money in, then they will match it. So maybe you put in 5% of your pay and they match it with another 5%, or maybe they may match it double, or they may match it half. But in any event, anytime your employer is willing to match your contributions, that's an opportunity you really don't want to pass up, because that's free money. And then I've also, in this example, indicated that we have a little bit withheld for United Way contribution. So we have total withholdings of $799.50. So the take-home pay is $2,200.50. The way that'll be recorded is the wage expense will be for the entire $3,000, but then we're not going to pay all of that to one person. All of these different amounts withheld are credited to different payable accounts. These are liability accounts because you, the employer, have the responsibility of withholding from your employees and then paying the different parties, for instance, the government or the insurance company or the pension plan. So you have the responsibility of passing that on. So each of those liability accounts, I've got them in the ledger over here. And then the take-home pay would be a check made out to the employee, and that'd be a credit to cash. In addition to the recording the wage expense and what we withhold from the employee, the employer is also responsible for paying their part of the FICA taxes and also unemployment tax. So another journal entry, this is on top of that $3,000 wage expense. We also have to record the employer's payroll taxes. So I have credited the FICA tax payable for the other half, the employer's half of that. We also have unemployment taxes, and those kind of depend on the unemployment experience of the company and the tax rate that they're subject to. And the federal government, a lot of times the more you pay to the state, the less you have to pay to the federal. So this stands for Federal Unemployment Taxing Authority and State Unemployment Taxing Authority. So I just gave a couple of percentages here, which again you don't need to know. But and I credited a liability for those unemployment taxes. I do want you to know that it's the employer that pays unemployment taxes. The employee does not. And then, assuming that the employer was matching part of the 401k contribution, I set up an additional benefit expense for that. So these different credits go to various liability accounts. The expenses, of course, are recorded under retained earnings. And then, on whatever the due dates are, these amounts would need to be paid. So, oftentimes I talk about this discussion of payroll as being one of the most depressing topics we talk about in the entire semester because nobody wants to think about how much is being withheld from their paycheck. But if you go into it with eyes wide open and you understand that you're going to have these amounts withheld, then you can set your lifestyle according to that take-home budget and keep yourself from getting into debt and so forth. Okay, that's sales taxes and payroll taxes. That is the first of 3 videos in Chapter 7. Video 2 will be about notes payable and paying interest on a loan. And then video 3 will be about borrowing money by issuing bonds. So see you in the next video.